Hello, in this video, I wanted to explain the database is in 19.4. Localization is using United States at the moment, but it doesn't mean it cannot, this video doesn't work for other localization. It doesn't mean that you have to test it yourself and see if we get the same result. Most likely we should get the same result as long as the valuation you're setting up the same. And specifically, I wanted to show you the product category setting and then the product setting before we talk about the cases. And this video, we wanted to talk about the inventory valuation report, variation, and accrual entry. So category for average costing is using average, and then I have product A and C. Okay. For FIFO costing, I'm using first in, first out. Inventory valuation and variation. Valuation, you use variation. Valuation is current asset. Variation is also current asset type of account. So that's all for the settings. We're going to create a purchase order. So there's going to be 4 different purchase order that we're checking. I'm going to come back to this report later. So purchase order, we start from purchase product A, $100. So first, by buying a product A for $100, one for $100, we are going to, oh, there's no warehouse. 1 second. All right. I'm gonna just, okay, so create a purchase order, vendor, and then product A, one for $100. So you're gonna receive and get the bill for $100 as well. Okay. So we get a vendor bill. You wanted to specific the date, and then you're just gonna use inventory valuation account. By doing so, your inventory report on the stock report had the value of $100. And that match your accounting balance sheet report of accounting is $100 as well. So coming to inventory valuation, review valuation, this report, you will see initial balance actually comes from accounting, ending balance comes from inventory stock, and B minus A will be the same. That will be the stock variation. Right now, 100 and 100 is the same, so it's 0 here. All good. Let's take a look at case 2 for FIFO for $200. Okay, so purchase this time is B. Ooh, there's 2B. Well, I'm gonna delete this B. There's no categories. I'm gonna delete this. No, I'm gonna buy another B. I'm gonna buy this B. This B would be FIFO. All right, so this one is $200. Okay, so save. Oops, confirm. And then, okay, so I wanted to show you after I receive, but I don't have a bill. The bill will happen the other day. What happened to valuation report? So receive and validate. I haven't got a bill yet because that's probably tomorrow. So if right now I go to accounting and check the valuation, it's showing 200. Why? Valuation come from inventory stock. Inventory stock. What's my value? 300. Coming back to accounting, inventory valuation, initial balance comes from accounting. Reporting, balance sheet, accounting, 100. So it's tell you you have, as of right now, you have $200 off on your inventory valuation. So you can choose to generate the entry. If I say, no, I don't want to generate entry, I'm just going to take a look. If I'm just only taking a look, then okay, I can just wait until tomorrow when I get the bill. All right, it's tomorrow. Let's go and create a bill. Upload the bill. Create a bill for $200, same value, nothing changed. Let's say it's 1 day later, valuation as well, confirm. The moment I do that, accounting, valuation, now it's 0. But it's different. If you start creating the entry, you have to create a second entry. So let's talk about case 3. Let's do a make a purchase. This is also product B for 300. Purchase for product B. This is for 300 this time. Okay, confirm and receive. And I don't have anything yet. I don't have a bill. Go to accounting and then valuation. If you start to create an entry from the beginning, fine, you are making sure accounting value, valuation, match inventory stock. Okay. But the moment you start doing that, let's say, okay, it's also tomorrow, I got a bill as well, and it's just 1 day later. At the moment I got the bill, it's using valuation account. At the moment I got the bill, I will double count my valuation twice. So accounting shows 900 while my inventory still shows 600. So because of that, accounting for the valuation is asking you to reduce the entry that you create the first time. Remember, you generate the entry first time. We need to generate entry the second time to offset because the value actually comes from vendor bill. We don't know when vendor bill comes, but when it comes, you have to create a second entry to offset, so generate entry. It didn't really explain why, but that's just how it works. By doing so, you can guarantee your accounting value actually match inventory value. That's it. Okay. Now, fourth step is averaging. For averaging, $200. We're gonna return later. So purchase. This is averaging cost. So you buy 100 and buy 200. Now your unit cost changed to 150. Right now I haven't received. Before I receive anything, my cost is 100. The moment I receive, validate at the $200 value, my product unit cost becomes 150. That's just how averaging work. Okay, and then I got a bill for 200. Okay, fine. What if now I said, hey, I wanted to return this product at $100, which remember I do have one at $100. I want to return it. What happened? So before you return anything, your accounting balance it's properly fine. 800 match stock, 800 you're good. But the moment you start returning, that's when the problem happened because of averaging. So you return this receipt, return, validate a return. Oops. You return it, you get a bill, you get a refund of the bill. Okay, confirm. Now everything is fine. Mm, what happened to your valuation report? The report shows you have 50. Why? Because again, it's a valuation thing. Because right now, the moment you return a product for 100, it already been averaging out to 150. Now the product that you have left, even though you bought for 200, it shows that you actually have 150 left. So there's about $50 differences. So you needed to do an adjustment on these valuation entry. And in this valuation entry, the variation goes to cost of goods sold because at the moment, if you do sell these products, your cost of goods sold will be 150 from the inventory, where you're missing this $50 that should also be cost of goods sold. All right, so you can just adjust this variation cost of goods sold. Now I'm gonna leave it for you to make this decision, but knowing that right now there's 50% contribute because of averaging costing return, which is uh, could be a cost of goods sold. Now, let's say today is also end of the month, August 31st, that you're going to do a closing entry. Uh, Wait a second. Before we do a closing entry, let me buy another FIFO product that I have no vendor bill at all. Let me buy 500 and I don't have and no vendor bill. And then you do closing. All right. So let me try that. Right now, I'm going to do another purchase order for 500. Okay. I'm going to just receive, but I don't have the bill. Validate. All right. So right now, my inventory report shows me, sorry, accounting shows me I have 450 differences. So there's 500 contribution minus that $50. Okay. Now, how do, like, if you are doing a closing entry, you could say, okay, what are these 450 comes from? Now, that's where another tools I wanted to introduce. These four things: purchase, bill to receive, bill not receive, sales, invoice to be received, sorry, invoice to be issued, invoice not delivered. All these four, I will call it as an accrual. Again, in this particular use case, let me take a look. Okay. In this use case, I only cover purchase. I didn't really cover sales. So I'm not really covering this too. But if you take a look at this two, bills to receive, meaning you receive something, but you're pending for bill. And another one is the other way around. You bill something, but you haven't received. But I don't have that case, so it's empty. Now, what I'm trying to say is imagine this fourth thing for accrual is a breakdown of inventory valuation. So like, okay, what is this 450 coming from? You could say, okay, it's probably take a look at this. But in this bill to review to receive, it tells you 500. So within 450, there's $500 from missing a bill. Now, what about a 50? That's when, as you know, the $50 come from product return. So then during the closing, but you don't know because you might close it once a month or once a year. There's might be thousand and thousand of transaction. How would I know at every given penny it's coming from returns, coming from? I have no clue. So I'm only just doing at the closing to see the differences and knowing what to book. So in this case, I know 500 comes from accrual. So I can just do variation against my accrued account, and you can say bill to receive account, missing a bill, meaning I did receive product, but I'm missing the bill, and create an entry. So they would debiting the variation and crediting the bills to receive. All right, so what it does is you could start by doing the valuation first. This way, I can this way Odoo is trying to match your accounting valuation against your inventory stock, 1150. So if you start with this, and this is the closing process, if you start with accounting, valuation, generate entry to bring up your valuation by 450, now your accounting here uh, does match your inventory report. But what does this 400 comes from? Do I book them all to the cost of goods sold? Not necessarily. That's when you need a second tools, which is accrual. You come to bill to receive, and then you say, okay, let's book this variation to these bill to receive because at the point I might receive a bill in the future, right? Okay, so this entry again is for closing. So it's not really normal on August, middle of August. It's usually end of August or end of the month or end of the year. And then this entry will be reversed the other day. So you don't need to, similar to this valuation, you don't need to generate entry second times. Now, what happened is if you look at the balance sheet, my variation as of today and the closing day, I only have 50 left because I booked the other one to a bill to receive account. Now, what happened here is I shouldn't expect to see 50. These have to be gone to zero. And as we know, because it's coming from return product, so you should do a manual adjustment, make sure it's zero to book it to cost of goods sold. So this is a um, manual variation adjustment. at closing. Now you would do variation because right now is debiting. So you wanted to credit 50, debit to cost of goods sold. Okay, and post it. Now your book is fully cleaned. Your valuation match with your inventory. And then there's no variation. Even though there's variation that comes the other day, it stays open because you do have some purchase order that was missing bill. So that's the normal process of the closing. I hope that makes sense. Thank you so much for watching.